Happy New Year! Let's get the good news out of the way before the Europeans return from holidays and start trying to solve their debt problems. Trading's very light, but markets responded to a lift in Europe and signs that manufacturing was picking up in China and Australia. So we saw some of the big resource stocks up today, as were the banks. Still no joy for many discretionary retailers, but their landlords fared better. Most analysts have Australia's share market rising this year since it's gone down 2 years in a row. The last time it happened, in 81-82, we saw a big rally in 1983. In fact, the 60% rise in the All Ordinaries Index in 83 was the biggest percentage rise in more than 30 years, so maybe there's hope, although the combined fall in the 80s was more than double the falls in 2010 and 11 in percentage terms. As I mentioned, part of today's excitement came from the manufacturing index, which jumped above 50 for the first time in 6 months. Anything above 50 means the sector is growing rather than shrinking. Production picked up and is now expanding, but there was a big fall in manufactured exports. Blame it on the dollar, which is up across the board. The trade-weighted index, a measure of the dollar against a basket of currencies, is at a 2-month high. And those Middle East tensions are supporting oil prices. Oil was over $100 a barrel in New York at one stage, and wholesale prices for unleaded petrol are on the way up. They're at a 2-month high, which means prices at the pump should soon be on the way up as well. And that's finance.